There is a specific hidden pattern across every major financial collapse in the last 100 years. Look at the Roaring '20s boom. It ended with the Great Depression that destroyed 89% of stock market wealth and left entire families destitute. Look at the 1970s stagflation, a decade where inflation gutted the value of bonds, which were supposed to be safe, and vaporized the purchasing power of cash savings. Look at the 2008 financial crisis, a global credit freeze that wiped out $10 trillion of household wealth and caused the entire banking system to nearly collapse. Look at the sudden COVID crash of 2020, or the brutal tech sell-off in 2022. 5 completely different economic seasons. A speculative boom, a destroying inflation, a credit contraction, a deflationary depression, and yet 4 specific positions survived all of them, not 5 positions, not 10 complex hedge fund strategies. 4. The same 4 that worked in 1929, the same 4 that worked in 1973, the same 4 that worked in 2008, 2020, and 2022. This isn't theory. Ray Dalio, the founder of the world's largest hedge fund, built a $15 billion personal fortune based on the logic of these 4 positions. Central banks globally are currently holding over $30 trillion in these exact asset classes to protect national wealth. And despite every crash, every panic, every war, and every recession, this specific combination has delivered 9.7% annual returns for 50 years straight. But most people don't hold them. They chase returns. They buy what is hot right now. They panic during crashes, and they lose everything because they fight the cycle instead of riding it. The pattern says regardless of what season comes next, inflation or deflation, boom or bust, 4 positions survive. They preserve wealth when everything else is falling. They compound over time. And most importantly, they position you to buy when everyone else is forced to sell. Right now, in late 2025, the signals are flashing again, and the smartest investors in the world are positioned in these exact 4 assets. Because understanding this pattern gives you something most investors never have: certainty. Not certainty about which crisis comes next, but certainty that whatever crisis comes, you will survive it. Before I show you the 4 positions, you need to understand why 4 specifically. Why not just hold a safe portfolio? Why not 10 different positions for every scenario? Because financial markets have 4 fundamental seasons, and each of the 4 positions addresses exactly one of those seasons. Season 1 is spring, or economic growth. The economy expands, earnings rise, innovation accelerates. In this season, stocks thrive. The risk is not holding them. If you are not in stocks during spring, you miss the boom. Think of the 1990s or the 2010s. 20 years of spring. Investors who sat in bonds or gold during these times lost to inflation and opportunity cost. Season 2 is summer, or inflation. The economy grows too fast. The Fed prints too much. Prices surge, and the dollar buys less. Stocks go sideways. Bonds are destroyed. The 1970s was a 12-year summer. Bonds lost 50% in real terms. Savings lost 7% of their value annually. In this season, you need assets that rise with prices, not fall with currency debasement. Season 3 is fall, or a credit crunch. The economy contracts. Earnings get cut. Credit tightens. Stocks crash 30 to 50%. The 2000 tech crash. The 2008 financial crisis. If you are 100% in stocks during fall, you lose half your wealth. You need safety. You need liquidity. You need assets that hold value when everything else collapses. Season 4 is winter, or deflation. This is the worst season. Asset prices collapse. Businesses fail. Unemployment surges. In winter, cash is king because prices are falling. The 1930s was a 10-year winter. Stocks fell 89%. Real estate fell 50%. But cash gained purchasing power, and those with cash bought entire companies for pennies. Every crisis in history falls into one of these 4 seasons, or transitions between them. The Great Depression was winter. The 1970s were summer. 2008 started as fall, then became summer when the Fed printed. COVID was fall for 3 weeks, then summer when stimulus hit. If you hold all 4 positions, you are protected regardless of which season we are in. Position 1 captures spring. Position 2 protects you in summer. Position 3 saves you in fall. Position 4 dominates in winter. Together, they create the all-weather portfolio, not because it performs best in every season, but because it survives every season. And survival is what matters. Because the investors who survive crashes are the investors who have capital to deploy at the bottom. And buying at the bottom is where generational wealth is created. But you can only buy at the bottom if you survive the crash. The 4 positions ensure survival. Let me show you exactly how this pattern works through 4 completely different crises. Starting with the Great Depression, 1929 to 1939. This is the ultimate deflationary collapse, the darkest winter in modern financial history. Let's see how the 4 positions performed. Position 1. Stocks. The S&P 500 fell from 381 in September 1929 to just 41 in July 1932, an 89% collapse. If you had $100,000 invested, it became $11,000 in less than 3 years. This is why you cannot hold 100% stocks through a winter season. Stocks are designed for spring. They die in winter. But here is the key pattern most people miss. If you bought the S&P at the peak in 1929 and simply held through the depression, by 1945, you were back to even with dividends reinvested. By 1950, you doubled your money. By 1960, you quintupled it. The depression lasted 10 years, but the recovery lasted 30 years. The investors who held the S&P through the winter and into the spring created generational wealth, not by timing the bottom perfectly, but by surviving the winter. Position 2. Long-term government bonds. In a deflationary winter, long-term government bonds act as a fortress. A $1,000 government bond, bought in 1929, was still worth $1,000 in 1933. It held its nominal value. But because of deflation, the prices of goods and services in the economy collapsed by 25%. That means your $1,000 bought 25% more real goods in 1933 than it did in 1929. Real returns of 25% without doing anything. But there is a critical distinction here. This only applies to government bonds. Corporate bonds collapsed 50 to 70% during the Depression because companies went bankrupt and defaulted. The lesson is clear. In fall and winter seasons, you hold government bonds, not corporate debt. Government bondholders survived. They preserved their wealth. And they maintained their purchasing power while everyone else was being liquidated. Position 3. Gold. In 1929, gold was fixed at $20.67 per ounce. So holding gold meant your wealth was strictly preserved through the initial crash. It did not drop 89% like stocks. It stood like a rock. But here is where gold became extraordinary. In 1934, President Franklin Roosevelt devalued the dollar to fight deflation. He revalued gold from $20.67 to $35 per ounce. Overnight, anyone holding gold saw a 69% gain in dollar terms. Your gold did not change. The dollar price of gold changed. This is why gold survives every crisis. Governments cannot devalue gold. They can only devalue their currencies relative to gold. Investors who held gold preserved wealth during the crash, and they gained massive wealth during the devaluation. Position 4. Cash. In the Great Depression, cash dominated. The dollar was gold-backed at the time. When the market crashed in October 1929, cash did not fall. Because of deflation, cash gained 25% in purchasing power. But cash provided something even more valuable than purchasing power: optionality. When stocks collapsed, when entire buildings were being sold for the price of their lobbies, when companies traded for less than the cash on their balance sheets, cash holders could buy. Bernard Baruch is the famous example. He sold his positions before the crash and held massive amounts of cash. He waited. He deployed that cash in 1932 and 1933 at fire sale prices. By 1936, he was wealthier than before the crash. Treasury bills, which are essentially cash that pays interest, performed even better. They paid 3 to 4% interest, while prices fell 25%. That is a real return of 28 to 30%. Cash and T-bills were the ultimate winter asset. Now look at the synthesis of these 4 positions. Imagine a portfolio with 25% in each. Stocks fell 89%, causing a 22% impact on the total portfolio. Bonds held nominal value and gained 25% in purchasing power. Gold preserved value initially, then gained 69% by 1934. Cash gained 25% in real terms, while the stock-only investor lost 89% of their wealth. The four-season portfolio actually gained about 8% in real terms during the worst crisis in history. The stock-only investor was destroyed. The diversified investor survived and grew. This is the power of four-season positioning. It is not about maximum returns in one year. It is about survival through every season. Now let's look at the opposite crisis. Summer, 1973. Stagflation. 1973 to 1982. This was the exact opposite of the Great Depression. Not deflation, but inflation. Not falling prices, but rising prices. This is where most traditional portfolios died, because the assets that worked in the Depression stopped working in stagflation, except for the four-season framework. Let's see how they performed. Position 1. Stocks. The S&P 500 effectively went nowhere from 1968 to 1982. 14 years of flat performance. In real terms, adjusted for inflation, stocks lost 48% of their value. Even with dividends reinvested, you only made about 5 to 6% annually, which was below the inflation rate. You lost purchasing power every single year, but you survived. You did not get destroyed. And here is the key pattern. In 1982, when inflation finally broke, when Paul Volcker raised interest rates to 20% and the economy entered a recession, when everyone was terrified of stocks, the market bottomed. From 1982 to 2000, the S&P returned 17% annually, the greatest bull market in history. The investors who held stocks through the summer of the 1970s participated in the spring of the 80s and 90s. They didn't get rich in the 70s, but they were positioned for the boom that followed. Position 2. Long-term bonds. This is where the summer season destroys wealth. Long-term bonds were crushed. If you bought a 30-year Treasury bond in 1971, it paid a 6% yield. That looked good at the time. But by 1981, inflation was running at 10 to 12%, and new bonds were paying 15%. When yields rise, bond prices fall. Investors holding those old 6% bonds saw their market value collapse by 50% in real terms. Anyone holding fixed-rate long bonds saw half their purchasing power wiped out. They earned 6% while inflation was 12%. They fell behind every single year. However, short-term Treasury bills adjusted. By the early 80s, T-bills were yielding 15%. Finally outpacing inflation. The lesson here is critical. In an inflationary summer, you do not want long-duration bonds. They suffer massive losses. But in a diversified portfolio, these losses are acceptable because of what happened to Position 3. Position 3. Gold. This was gold's decade. This is why you own it. After the U.S. abandoned the gold standard in 1971, gold exploded. It started at $35 per ounce in 1971. It hit $200 by 1974. It hit $300 by 1978. And it peaked at $850 in January 1980. A 24x gain in one decade. A 2,300% return. Nothing besides Bitcoin has ever rivaled this kind of move. Why did it happen? Inflation was running at 7 to 9% annually. The credibility of the dollar was in doubt. There was an oil embargo. Investors fled paper assets for hard assets. A simple 10% allocation to gold in 1971 could have grown to 50% of your entire portfolio by 1980. This is where the strategy of rebalancing creates magic. Investors following the four-season approach, like Harry Brown's permanent portfolio, were selling gold as it rose. They were taking profits from the asset that was up 2,300%, and they were buying stocks and bonds which were cheap. Gold was the ultimate summer asset. When fiat currency lost value, gold not only preserved wealth, it multiplied it. It gained 1,300% more than inflation, while stocks and bonds were floundering. Position 4. Cash. In high inflation, cash is supposed to be trash. Bank accounts paid 5%, while inflation was 12%. You lost purchasing power rapidly. Savings evaporated. But cash has a unique property. It resets quickly. By 1980 and 1981, Treasury bills were yielding 15%. They were finally matching and beating inflation. Cash was a mixed bag. It lagged from 1973 to 1978, but it became competitive by the end. Crucially, it provided liquidity. Those with cash in 1981 could lock in those historic 15% yields. Or they could deploy that cash into the stock market in 1982 when valuations were at single digits. The 25% cash position dragged the portfolio during the worst inflation, but it provided the dry powder to rebalance into the opportunity of a lifetime. Now look at the synthesis. Stagflation destroyed the traditional stock and bond investor. A conventional 60-40 portfolio had a 0% real return for the entire decade, but gold's massive gains carried the four-season portfolio. Imagine the 25% split starting in 1970. Your gold position went from $2,500 to $60,000. Your stocks doubled to $5,000 thanks to dividends. Your bonds stayed flat in nominal terms. Your cash grew moderately. After annual rebalancing, the portfolio ended the decade dramatically higher. The permanent portfolio delivered a real, inflation-adjusted return of 5.2% annually during the 1970s, while everyone else was losing money to inflation. In 1973 and 1974, when stocks crashed 50% and inflation surged, the permanent portfolio was down only 5.4%. Gold and bonds offset the stock losses. It works in the winter of 1929. It works in the summer of 1973. Opposite seasons, different dynamics. But the same four positions survived. Now we move to a different season. Fall 2008, the global financial crisis. This was a classic fall season, a credit crunch, a massive contraction after a debt boom. Lehman Brothers failed in September 2008, and the entire global banking system nearly collapsed. Let's see how the four positions perform. Position 1. Stocks. From October 9, 2007 to March 9, 2009, the S&P 500 fell 57%. Over half of all equity wealth vanished in just 17 months. Investors holding heavy stock portfolios were crushed. Millions panic sold at the bottom because they couldn't take the pain. If you had held through, you recovered your money by early 2013. And from the 2009 bottom, stocks returned 400% through 2020, the greatest bull market since the 90s. The lesson is clear. In an autumn crisis, stocks will plummet, but a balanced portfolio ensures you are not forced out of the game. The key is surviving the fall without capitulating. Position 2. Long-term bonds. In 2008, bonds were the savior. When investors panic, they flock to safety. They sell risky stocks and buy U.S. Treasury bonds. The Fed cut rates to near zero by December 2008. This caused bond prices to soar. The long-term Treasury ETF, TLT, gained 33% in 2008. 30-year yields crashed from 4.7% to 2.6%. This provided a crucial cushion. While your stocks were being cut in half, your bonds were gaining massive value. In the permanent portfolio, the 25% bond allocation contributed an 8 to 10% gain to the total portfolio. This is the power of negative correlation. In a recession, bonds zig when stocks zag. 2008 proved that bonds are your insurance policy during the fall. Position 3. Gold. Gold behaved interestingly in 2008. During the initial panic in September and October, gold actually fell sharply. It dropped from $900 to $700. Why? Because of a liquidity crisis. Investors were forced to sell everything, including their winners, just to raise cash. But once the Fed responded, once they announced rate cuts and quantitative easing, gold reversed. By early 2009, it was rising again. And over the next few years, it skyrocketed to $1,900 by 2011, a 2.7x gain from the lows. Gold anticipated the inflationary implications of the trillions of dollars being printed to save the system. Gold may dip in the initial shock of a crisis, but it shines in the aftermath when the printing press turns on. Position 4. Cash. In 2008, cash was king for those who had it. T-bill yields went to near zero because everyone was buying them for safety. But the value of cash wasn't the yield. It was the opportunity. Having cash allowed you to make a killing. Warren Buffett's Berkshire Hathaway held $40 billion in cash going into 2008. He deployed it at peak fear. He invested $5 billion in Goldman Sachs. He invested $3 billion in GE. He netted huge profits in the subsequent years because he bought when everyone else was selling. In the four-season portfolio, cash lost nothing. It earned interest early in the year. And most importantly, it provided dry powder to rebalance into stocks at the lows of March 2009. Without cash, you are forced to watch the sale of a lifetime pass you by. With cash, you buy when there is blood in the streets. Now look at the synthesis. In the full bear market from October 2007 to March 2009, The S&P 500 lost 57%, but a diversified portfolio with 25% in each asset lost only about 5%. Stocks were down 37% in the portfolio, but bonds were up 33%. Gold was flat. Cash was slightly up. Think about that difference. Down 57% versus down 5%. Not losing much means a much quicker recovery. The four-season portfolio broke even from the crisis by 2009. It hit new all-time highs by 2012. The stock-only investor had to wait until 2013 just to get their money back. By drastically reducing the drawdown, you survive the psychological pressure, and you keep compounding while others are digging themselves out of a hole. Finally, we look at the most confusing crisis of all, the mixed season of 2020, the COVID pandemic. This was a rapid-fire economic cycle. We went from fall recession to winter panic to summer money printing to spring recovery, all within a matter of months. Early 2020 saw the fastest crash in history. The S&P 500 fell 34% in just 5 weeks, from February 19th to March 23rd. But then came massive intervention. The Fed printed $3 trillion. Rates went to zero. Stimulus checks hit bank accounts. Let's see how the four positions handled this chaotic speed. Position 1. Stocks. The plunge was brutal. The index fell from 3,400 to 2,200 in just 23 trading days. But the recovery was just as fast. By August, stocks were back to new highs, and the S&P ended the year up 16%. The all-stock investor who didn't panic was made whole by August. But many panic sold in March because the world looked like it was ending. A balanced portfolio mitigated that drawdown and made holding through the panic possible. Position 2. Long-term bonds. When stocks crashed in March, long-term treasuries spiked. The ETF TLT gained 20% during the worst of the sell-off. 10-year yields fell from 1.5% to 0.5%, an all-time low. Bonds provided an excellent buffer exactly when it was needed. Later in the year, bonds gave back some gains and finished flat, but they did their job in March. They cushioned the fall when stocks were collapsing. Position 3. Gold. Gold mirrored 2008, but at turbo speed. During the initial liquidity crunch in March, gold fell 12%, from $1,550 down to $1,360. But as the Fed unleashed $4 trillion of quantitative easing, gold took off. By August 2020, gold hit a new all-time high of over $2,070, a 40% gain from the March lows. It ended the year up 25%. Gold contributed strongly to the portfolio's recovery after the initial shock. Position 4. Cash. 2020 was a spectacular example of cash opportunism. Bill Ackman is the perfect case study. He held cash and used it to buy credit default swaps in February for $27 million. He cashed them out in late March for $2.6 billion. Then he immediately deployed that cash into stocks at pandemic lows. He bought companies like Hilton and Starbucks at 40 to 50% discounts. Within months, those positions doubled. The value of cash is what it allows you to do. Those with dry powder in March 2020 saw tremendous gains by year end. Now look at the synthesis. The 2020 balanced portfolio saw a small dip and then a solid gain. Stocks were up 16% for the year. Bonds were flat. Gold was up 25%. Cash was flat. The overall return was between 8 and 12%. But the maximum drawdown in March was only about 10%, compared to 34% for stocks alone. It was much easier to stomach. It was much harder to panic sell. Different assets took turns carrying the load. Bonds cushioned the crash. Gold and stocks powered the recovery. Cash enabled rebalancing. 4 completely different crises. The winter of 1929, the summer of 1973, the fall of 2008, the mixed cycle of 2020. But the same 4 positions survived and thrived in each one. You have seen the pattern. 4 crises, 4 survivals. But you need to understand why these 4 positions specifically. Why not real estate? Why not Bitcoin? Why not commodities? Because these 4 positions represent the fundamental building blocks of the financial world. Each one is designed to survive a specific economic season. Position 1 is stocks. Why do you need them? Because they represent ownership in productive businesses. Over the long term, companies innovate. They grow earnings. They expand. For 100 years, U.S. stocks have delivered about 10% annually after inflation. $1 invested in 1926 became over $10,000 by 2020. No other asset class comes close to that growth, but they have a fatal flaw. They crash during recessions and credit crunches. 2008, minus 57%. 2000, minus 50%. 1929, minus 89%. If you are 100% in stocks during a crash, you lose half your wealth. And psychologically, you are likely to panic sell at the bottom. But if you hold 25% in stocks, a 50% crash is only a 12.5% loss to your portfolio. It is much easier to hold through. You need stocks not for safety. You need them for long-term growth, to participate in the spring when the economy expands. Position 2 is long-term government bonds. Why do you need them? They are the mathematical opposite of stocks. You are lending money to the government. The government promises to pay you back with interest. They don't grow much, maybe 5 to 6% annually over a century. But they have one superpower. They rise when stocks fall. In recessions, fear hits. Credit tightens. Investors flee to safety. They sell stocks and buy government bonds. This pushes bond prices up. In 2008, stocks were down 37%, but long bonds were up 33%. In March 2020, stocks crashed, but bonds spiked 20%. This negative correlation is your insurance policy. When the Fed cuts rates to fight a recession, bond prices soar. A yield drop from 5% to 2% makes your bonds suddenly worth much more. You need bonds not for growth. You need them for protection during the fall, when the economy contracts and stocks crash. Position 3 is gold. Why do you need it? Because gold is money, not government-issued currency. Real money. It has been recognized as a store of value for 5,000 years. Why? Because it cannot be printed. Governments can print unlimited dollars, euros, and yen. They devalue currencies to fight deflation or reduce debt, but they cannot print gold. The supply of gold is limited by physics and mining production. When governments print money, gold appreciates. From 1971 to 1980, the U.S. printed money for stagflation, and gold went from $35 to $850. From 2008 to 2011, the Fed printed trillions for QE, and gold went from $700 to $1,900. From 2020 to 2024, the Fed printed $4 trillion for COVID stimulus, and gold went from $1,500 to over $2,700. And now in late 2025, gold is trading at $4,070 per ounce, up 54% this year alone. Why? Because central banks know the pattern. They currently hold 36,000 tons of gold reserves. In the third quarter of 2025 alone, they bought over 720 tons. China, Russia, and emerging markets are accumulating aggressively. They are preparing for the next summer season of inflation and currency debasement. You need gold, not for income. You need it for protection against the destruction of fiat currency. Position 4 is cash. Why do you need it? It seems boring. It doesn't grow. It doesn't pay much. It loses value in inflation. So why hold it? 2 reasons. First, deflation protection. In a collapse like the 1930s winter, prices fall and cash gains purchasing power. But the second reason is more important. Optionality. The ability to act when others cannot. When markets crash, assets go on sale. Everyone else is forced to sell or frozen in panic. Cash holders buy. Warren Buffett in 2008 deployed billions at peak fear to buy Goldman Sachs and GE. Bill Ackman in 2020 deployed billions at the lows to buy stocks at 50% discounts. Bernard Baruch in 1932 deployed cash to become wealthier than before the Depression. The pattern is clear. The investors who get rich in crashes are not the ones with perfect timing. They are the ones with cash to deploy when assets are cheap. But you can only deploy if you have the cash. If you are 100% invested in stocks, you have no dry powder. You are forced to watch the sale of a lifetime pass you by. You need cash, not for growth. You need it for the ability to buy when there is blood in the streets. It is the ultimate winter asset. The 4 together: stocks for growth, bonds for recession protection, gold for inflation protection, cash for opportunity. No one knows which season is coming next, but holding all 4 ensures you survive every season. And survival is what allows you to build generational wealth. Now, let's look at where we are right now. Late 2025. Which season are we in? The signals are completely mixed. On the surface, it looks like spring. The S&P 500 is near all-time highs at 6,600. Unemployment is low. Corporate earnings are solid. But look deeper at what the smart money is doing. Warren Buffett at Berkshire Hathaway is holding $382 billion in cash and treasury bills. That is the largest cash pile in the history of his company. He has been a net seller of stocks for 12 consecutive quarters. He trimmed his massive Apple position by 40%. He has been selling Bank of America continuously. He has not bought back his own stock for 5 quarters. Buffett is seeing valuations that look like 1999. He is preparing for winter. Now look at gold. It is trading at $4,070 per ounce. It is up 54% year-to-date in 2025. It hit an all-time high of $4,371 in October. Central banks bought over 720 tons in the third quarter alone. China and Russia are accumulating aggressively. They are preparing for summer. And look at valuations. The Shiller-Cape ratio is hovering around 40. The historical average is 16. The last time it was this high was November 1999, right before the dot-com bubble burst. Stocks fell 50% over the next 3 years. But there is one bright spot. For the first time in 15 years, Treasury yields are attractive. The 10-year pays 4%. The 3-month pays nearly 5%. You finally get paid to wait. So is it spring, summer, fall, or winter? The truth is, no one knows. And that is exactly why you hold all 4 positions. Here is the actionable allocation based on the pattern and your age. If you are under 40 years old, you have time to recover from crashes and you want growth. I suggest 40% in stocks, 30% in long-term bonds, 15% in gold, 15% in cash. This tilts you toward growth but maintains protection. If stocks crash 50%, your portfolio is only down 20%. You can hold through and participate in the recovery. If you are between 40 and 60, these are your peak earning years. You want growth, but you need stability. I suggest 30% in stocks, 30% in bonds, 20% in gold, 20% in cash. This is close to the classic permanent allocation. If summer inflation hits, gold protects you. If fall recession hits, bonds and cash protect you. If spring continues, stocks give you upside. If you are over 60, you are approaching or in retirement. Capital preservation is more important than growth. I suggest 20% in stocks, 40% in bonds, 20% in gold, 20% in cash. Bonds provide steady income. Gold protects your life savings from inflation. Cash gives you liquidity for expenses. Stocks provide just enough growth to combat inflation over a 30-year retirement. But there is one critical rule you must follow. Rebalance annually. Once a year, you sell what is up and buy what is down to restore your percentages. This forces you to buy low and sell high automatically. In the 1970s, you sold gold as it went up 24x and bought cheap stocks. In the 1990s, you sold stocks as they boomed and bought cheap bonds. This discipline is what makes the 4-season strategy work over decades. Look at what we have learned. 1929 winter deflation. Cash and bonds saved the portfolio, while stocks recovered over 30 years. 1973 summer inflation. Gold gained 2,300% and carried the portfolio while stocks and bonds struggled. 2008 fall credit crunch. Bonds surged 33%. While stocks crashed 57%. 2020 mixed rapid cycle. Bonds cushioned the crash, gold and stocks powered the recovery. Cash enabled buying the lows. 4 completely different crises. 4 completely different economic seasons. But the same 4 positions survived and thrived in each one. This isn't theory. This is 100 years of empirical evidence. You have a choice. Option A is to chase returns. Go all in on stocks because they are going up. Bet everything on gold because you fear inflation. Sit in cash because you fear a crash. Maybe you will be right. Maybe you will time it perfectly, but you probably won't. Most people buy high, panic sell at the bottom, and miss the recovery. Option B is the 4-season approach. Stop trying to predict the future. Stop worrying about which season is coming next. Whatever season comes, you are prepared. If spring continues, your stocks go up. If summer hits, your gold protects you. If fall arrives, your bonds surge. If winter comes, your cash gains purchasing power and gives you the ability to buy at the bottom. You survive every season. I cannot promise you will get rich quick. I cannot promise you will beat the market every single year. Some years, stocks will crush this portfolio. Some years, gold will look stupid. But I can promise you this. You will survive. When the next crash comes, and it will come, you won't lose 50% of your wealth. You might lose 5 or 10%. You will sleep at night. You will have cash to deploy when others panic. And over 20, 30, or 40 years, you will compound wealth steadily, not with massive wins, but by not striking out, That is the power of pattern recognition. It worked for the last 100 years. It will work for the next 100 years. Because human nature doesn't change. Economic cycles don't change. Spring, summer, fall, and winter keep rotating. And these four positions keep surviving. The question isn't whether the next crisis is coming. The question is, will you be ready?